about Spacs. My name is Doug Johnstone, and I want to talk about a company, an acquisition actually. It's going to be occurring in July. If you haven't heard about, it's going to be popular news in the next few weeks. So Leo Holdings Corporation, ticker symbol LHC, which you can buy into right now, is acquiring with Digital Media Solutions, which in the future is going to be ticker symbol, if it goes through, DMS. And if you're familiar with LHC, Leo Holdings Corporation, last year they had a failed business deal with Chuck E. Cheese. They went to sign the merger, and then Apollo Management Group, the information was undisclosed, but Apollo Management Group, who managed Chuck E. Cheese, something happened at the very end, but it didn't go through. But they're back, and they're buying Digital Media Solutions. So the vote is on July 14th, and if it looks like it's going to be approved, and when it gets approved, if it does, on July 15th, it will be ticker symbol DMS. So what is Digital Media Solutions? And I'll tell you where they're located. They're located in New York City on 39th Street. And if you know 39th Street in New York City is, and you're a fan of Mad Men, you know it's the advertising world. Any company that's going to be in advertising is located right there on 39th Street in New York, around that area, around those blocks. And what this company is, they're in digital marketing, and this is a hot space for Wall Street. I think the average Spac investor, we're not consumers of, we're consumers of what the digital marketing is, but we're not actually in marketing business where we're invested, we're buying digital ad space. So this is a hot area by Wall Street. So I think if this does go through, it's going to be a big stock pushed by Wall Street. So let's talk about a little bit about DMS and what they are. So DMS, they have their own proprietary technology solutions with their own distribution, and they basically help brands steadily acquire more customers. And I'll get into why their platform is so great. So DMS helps clients de-risk marketing spend across digital channels through its pay-for-play performance model, meaning DMS gets paid to deliver customer conversions rather than simple impressions. So if you're a customer and you want to do some advertising, you're going to pay only on those costs when the acquisition occurs. So if you're a small business or mid-sized business, even a large business with a tight budget, you're not going to be paying for impressions just to see someone's advertising. When someone clicks and it gets active, you get paid for it. So as a result, brands are assured to make sure on each dollar spent on the DMS platform and are able to achieve a level of predictability at a scale traditional ad campaigns cannot match. So that's why they're going to be so much more successful than other ad companies. Their DMS is also partially owned by a Canadian hedge fund called Clairvis Group, and looking at their data, their stock is up 1,510%. And I'm sure it's not all DMS that's in there. They have a lot of other activities, but it is part of their portfolio. And I'll get into their financials a little bit. So we've got some information, and it's pretty interesting what you're going to see in there. So DMS, their largest customers right now are insurance companies, education, consumer finance, and health and wellness companies. And I was looking through their investor package they gave out, and they like companies like Car Gurus and some really well-known companies that they supply advertising for. So what's interesting is they have a 95% customer retention rate, and they have 150 million consumer profiles that they have. So I'm assuming I'm a consumer, you're probably a consumer. They might have our data, which is kind of good. It's kind of creepy as a person to know they have your data, but if you're in the business and you want to sell ads, it's good that you're investing in a company that has this type of stuff. And they have 25% year-over-year growth. It's a fairly new company, but they're exploding in growth. The total acquisition value is going to be $757 million. And I'm going to get into the accounting and financials for like 30 seconds. I know I don't want to bore you guys with this type of information, but just to show you how they're growing. So in 2020, their revenue is $340 million. In 2021 is $425 million. So the 2021 number, I don't know if their year end ended like maybe in March and you're in the next year, but it's either a forecast, but you can see that their revenue is exploding and is growing. Their EBITDA numbers, and if you're not into accounting or finance, that's fine, but EBITDA is very important. not so much from an accounting perspective, but if you're going to be buying a business, so EBITDA stands for earnings before taxes, depreciation, and amortization. And really what that means is it's basically taking out all the accounting and finance information and say, okay, let's get down to the flat number to see where the growth is. So in 2020, their EBITDA number is 57 million. And in 2021, their EBITDA number is 75 million. So that shows to me that it's a growing company without any of the accounting loopholes that they can apply. So it's a company that's showing solid growth. They also have free cash flows of 2020 $50 million and in 2021 of $68 million. And that really just signals that the company's ability to pay down debt, to pay dividends, do stockholders buybacks and such. So it really just shows that they're growing positively, which as an investor you want. So that's really good information. And the total value of the deal is $757 million. And when you look at it, the company financials, when the deal goes through, they're saying that it's going to be trading at 10.1 times the multiple of what the valuation of the company is based on their 2021 data. I did my own calculation based on the 2020 data. It's really 13.2%. And to put that into comparison, because I had to really look into the digital space, because it's not something that as an investor I look into a lot, this specific area. So I looked at the WPP Group, which is another publicly traded company in the same area, and their ratio earnings per share is 12.78%. So I could say that DMS is going to be in the same area. Also, Omnicom is at 8.98%, probably a little bit better value, but I don't know that business that well. But it does seem to be on target, especially if they're having year-over-year growth, organic growth of 25%. What DMS is going to do with the money once they get it is they're going to put $30 million on their balance sheet. It's probably going to go to more acquisitions or something else they're going to buy. I don't know that information. It wasn't given to us. They're going to pay down $10 million of DMS's current credit. They're going to pay party transaction costs, and they're going to pay a portion of the consideration to DMS equity shareholders. So they have a plan for the money, and I think this is just really going to infuse them to have future acquisitions and probably acquire more customers. And what's kind of interesting is I was looking through the details, and COVID does not affect this business. So I think just based on their platform and that they are only receiving money, if they can transform new customers to their product, especially when money's tight right now, they're saying that, hey, COVID is not really affecting us right now, and we're still seeing this, explosive growth. And their stock is LHC stock right now is $10.40. Okay, and it's a very interesting number, and I'll get into that why it's interesting. But when I was looking at their financial statements, so on July 14th, if this deal does not go through, guess how much money you get if your stock, if it doesn't go through? You get $10.40, and it looks like that can be paid out if it doesn't go through on July 31st of this year. So your money might be tied up for 2 weeks if you go into this merger and it's held up. But I guess my own personal take on this, I think as a Spac stock speculator, I don't see this stock necessarily blowing up, going to the moon in the short term. But I think once this deal goes through, I think Wall Street understands this area more than the common Spac investor, and they're going to be infusing money into this. It's a really hot area for Wall Street. I don't think it's going to go to the moon, but I think with their 25% year-over-year growth, I think it's going to be a solid investment purchase to buy. It's not going to be like a couple of these really bad ones we saw in the past week, like Free Seas, where the stocks opened up at $11. Now I think it's down at $7. They didn't have much growth. I was looking really at their numbers. I mean, it's really flat. But this is a different type. This is a different industry sector, and I feel like it's a good for a medium to long term play. If you're that type of investor. Personally, I don't have a stake in this company, but I'm actually thinking about buying maybe some in the next few days to see where it goes. If you guys like this content, please subscribe. I'd really like to get to a point where I'm able to really improve this page a lot with graphics and make it very interesting. My real end goal is to probably do 4 to 5 videos a week on Spac stocks that are interesting to people, and new ones coming up. So if you like the content, subscribe.